heavy, causing volume to rise, as the last remaining bulls finally throw in the towel. This is sometimes called a final washout, or a phase of capitulation that occurs at the very bottom of the end of the bear market. At that time, the media is clearly focused on the gloom and doom. Headlines about market crashes make the cover of major magazines. But at that point, the selling begins to ease and seeds are planted for another bull market. Always a bull market somewhere. History rhymes but never repeats. While there are often similarities between two time periods, two time frames are never exactly alike. Therefore, while we can learn from past experience, we can never predict exactly what will happen next. This is true in everyday life and also in the financial markets. Fortunately, one thing is almost certain: there are always trending markets somewhere. For example, specific sectors can move in bull and bear markets. In fact, some traders like to say that there is always a bull market somewhere. You can always find one if you look hard enough. Indexes and exchange-traded funds can help you spot these trends. Options can be used to generate profits from them. In 2004 and 2005, the major averages such as the Dow Jones Industrial Average and the S&P 500 index traded sideways, but energy stocks soared. At times, most of the market faced selling pressure, but oil and oil service stocks performed well. For instance, Figure 3.1 shows that from January to May in the year 2005, the S&P 500 index fell 5%, but the Trading the Market 31 Getting Sentimental. There are a number of trading tools that traders use to gauge market sentiment. The goal behind sentiment analysis is to gauge prevailing levels of bullishness and bearishness related to an investment or market. Traders want to go with the prevailing sentiment until it reaches an extreme. For example, bullishness often reaches an extreme just before the market turns south. Several sentiment indicators are discussed and explained in Chapter 10. 32. The Index Trading Course. Figure 3.1 SPX XLE Chart, January 2005 to June 2005. Source: www.profitsource.com. Select Sector Energy Fund XLE rallied more than 10%. In this case, the market was experiencing a pullback, but the bull market in energy continued. Conversely, there is almost always a bear market somewhere. In other words, there is almost always one sector or asset class that is experiencing a bear market. Even when the stock market is performing well, some sectors fail to participate. For example, Figure 3.2 shows that from October 2003 to February 2004 the S&P 500 traded higher, but the Amex Airline Index $XAL moved sharply lower. In Chapter 11, we explain what factors to consider when looking for bullish and bearish sector trades. In conclusion, indexes allow investors and traders to compartmentalize the market and view the performance of different areas of the market separately. Sometimes small caps will perform better than large cap stocks, or technology will outperform financials. Gold and bonds can perform well when the stock market is in a slump. The possibilities are almost limitless. Indexes, however, give investors the tools to help make sense of what is going on and, more importantly, anticipate what will happen next. Trading the Market 33 Figure 3.2 SPX XAL, September 2003 to February 2004. Source: www.profitsource.com. S&P Market Cap Indexes. Market capitalization or market value refers to the value of a company based on its stock price. It is computed by multiplying the number of shares outstanding by the market price of the stock. For example, if your company has 1 million shares outstanding and the stock is trading for $50 a share, the market value of your company is $50 million. Sometimes shares of smaller companies will behave differently than the shares of large companies. For that reason, it makes sense to monitor indexes that represent each asset class. Standard & Poor's has created the following 4 indexes. 1. S&P 600 Small Cap Index $SML. This index accounts for less than 5% of the total value of the U.S. stock market. It consists of 600 companies with market values between $600 million and $3 billion and is considered to be the leading small-cap companies in the marketplace today. The iShares Small Cap 600 (IJR) is an exchange-traded fund that tracks this index. Continued. Going long and selling short. In the index market, traders can go long or sell short. Going long is the easiest strategy. It simply involves buying shares, hoping they go up in price, and then selling them for a profit. Importantly, however, going long cannot be applied to an index. Indexes like the S&P 500 index, the Dow Jones Industrials, or the Nasdaq Composite cannot be bought or sold. They are simply benchmarks for tracking the stock market. Instead, investors can go long using exchange-traded funds. Going long simply means buying shares. When investors do this, they buy shares of the fund and hope that it increases in value. If so, shares can be sold later at a higher market price. This goes along with the old adage, buy low and sell high. For example, let's say the SPDRs are trading for $100 a share and the strategist expects a move higher within the next few months. In order to profit from these expectations, 100 shares are purchased for $100 a share. The cost of the trade is $10,000, or 100 times 100. If the SPY rises to $125 a share, the trade yields a $2,500 profit, $125 minus $100 times 100 shares. However, if the SPY falls to $80 a share, the trade loses $2,000, $100.34. The index trading course S&P Market Cap Index is continued to S&P Mid Cap Index $Mid. This index includes 400 companies with market values ranging from $1 billion to $4 billion. It is the most widely used gauge for the performance of mid-cap stocks. An ETF tracks the index and trades under the symbol MDY. 3. S&P 100 $OEX. The S&P 100 is one of the more popular index contracts and includes the top 100 companies that also have listed options. According to the Standard & Poor's website www.standardandpoors.com, since its introduction in 1983, an important criterion for index inclusion has been the availability of individual stock options for each constituent. The individual stocks within the index have an average market value of approximately $60 billion, ranging from $2.25 billion to almost $400 billion. The iShares S&P 100 fund is listed under the symbol OEF. 4. S&P 500 Index $SPX. The best-known S&P index consists of 500 stocks from a diverse set of industry groups. The market value of the combined companies equals 80% of the U.S. stock market. The companies within the index have an average market cap of $22.6 billion, with the smallest sporting a market value of $425 million and the largest, $375 billion. The S&P Depository Receipts (SPY) or SPDRs, is an exchange-traded fund that tracks the S&P 500 index. $80 times 100 shares. Ideally, the share price will move higher and the stock can be sold for a profit. This is the basis of stock trading, and it also applies to buying, or going long, ETFs. Exchange-traded funds can also be sold short. Short selling is a bearish market strategy that yields profits when the share price declines. When selling short, traders actually borrow shares from their brokerage houses. After the position has been opened, traders receive a credit in their account for the amount of the selling price. Trading the Market 35 Risk Graph's 101A risk graph, or risk curve, is a graphical depiction of the risk and reward associated with a trade. It shows the possible outcomes, including the potential profit and loss, or risk. Risk graphs are used extensively in options trading, including in this and our other books. The chart in Figure 3.3 provides an example. It shows the risk-reward associated with buying 100 shares of SPDRs. On the left-hand side we see the stock chart, which is simply the price move in the SPDRs over the past few months. The actual risk graph appears on the right-hand side. In this case, it is a straight line sloping upward from left to right because, as the SPY moves higher, the profit from holding the shares increases. The profit is plotted along the bottom axis and the stock price is on the vertical axis. Basically, the graph tells us how much money we will make or lose as the price of the asset moves higher or lower. Figure 3.3 Risk graph of 100 shares of SPY. Source: www.optionetics.com. Platinum. 36. The Index Trading Course. As an example, let's say a trader wants to place a bearish bet on the Nasdaq 100 Index Trust QQQQ, with the expectation that the share price will fall sometime during the next 6 months. An order is placed to sell short 100 QQQQ at a price of $35 a share. The broker then lends the 100 shares to the account and the Qs are then sold short. The proceeds of $3,500, $35 times 100 shares, are credited to the account. Now, if the price of the QQQQ falls to $30 a share, the strategist can buy back the 100 shares and return them to the broker. The cost is $3,000 to cover the short position. Therefore, the net profit, or the amount that is retained in the account, is $500. $35 minus $30 times 100 shares. What if shares rally? If the Qs move to $40 and the trader exits the position, the loss is also $500 because it costs $4,000 to buy back the stock and the credit from the short sale was only $3,500. $40 minus $35 times 100 shares. Figure 3.4 shows the risk graph of the QQQQ short sale. The left-hand side of the chart shows the movement in the underlying asset during the past few months. The right-hand side of the chart shows the potential profit or loss from future price moves in the QQQQ assuming an investor sells short 100 shares at $35 a share. For instance, at $40 a share, the loss is $500. However, if the price falls to $31 a share, the profit is $400. Figure 3.4 Risk graph of 100 short QQQQ. Source: www.optionetics.com. Platinum. Hopefully, the reader now has a good understanding of buying shares going long and selling shares going short. This is basic material that has been covered in greater detail in our earlier books. If the reader needs further clarification on these two strategies, we suggest reading two of our previous books, the Stock Market Course and the Options Course, for additional information. Charts and quotes: trading indexes without charts is like driving a car without your hands. While it might be possible, it isn't necessarily a good idea. Basically, charts make trading a lot easier. In addition, understanding and using charts can help identify trading opportunities that can't be found by simply watching the news or reading the newspaper. The process of finding a quote or a chart for an ETF or an index is the same as for a stock. For example, many websites offer free quotes, and finding the current market price for an exchange-traded fund is a simply matter of punching in the ticker symbol and hitting enter. For example, just enter QQQQ in the quote box at the top of the Optionetics.com homepage, hit enter, and voila, the system pulls up the latest quote for the Qs, as shown in Figure 3.5. The snapshot quote in Figure 3.5 shows that the QQQQ last traded at $40.92 for the day, which was down 66 cents from the day before. The high trading the market 37 Figure 3.5 snapshot quote of the Qs. Source: www.optionetics.com. Delayed quote as of December 19, 2005, 4:09 p.m. ET. Last 40.920 change down pointing arrow minus 0.660 open 41.680% change down pointing arrow minus 1.59% high 41.710 low 40.900 bid 40.870 ask 40.910 52 week high 42.310 52 week low 34.350 earnings per share minus 9,999.00 volume 75.42 M shares outstanding 729.8 M market cap 29.868 R E ration A exchange Nasdaq NM 38. The Index Trading Course. Price of the day is $41.71 and the low is $40.90. The QQQQ was bid for $40.87 and the ask price is $40.91. So an investor could buy shares for $40.91 and sell them for $40.87. This quote service is delayed, but it offers other information such as the exchange-traded fund's 52-week high and low, the day's volume, the total market value of the fund, and the exchange where the fund trades. Since the QQQQ is an exchange-traded fund, the earnings per share data is meaningless. Getting the latest quote for an index is just as simple. However, for indexes, many websites and quote vendors require the $sign before the symbol. For example, to retrieve the latest quote for the S&P 500 index, traders must enter the symbol $SPX. Therefore, if the symbol requires a $sign, it is an index. If not, it is a stock or an exchange-traded fund. Figure 3.6 shows an example of a quote for the S&P 500 index. Since it is a cash index, the bid and offer as well as a lot of other data included in Figure 3.5 are not present. Many websites offer free charts as well. However, to perform regular analysis of the index market, a more advanced software package is recommended. As we see in later chapters, looking at charts, plotting indicators, and performing analysis on a variety of different indexes can help to quickly identify profit opportunities. While advanced software is not required, it simplifies this process a great deal. First, let's cover the basics of charting. The bar chart, also referred to as Open High Low Close, or OHLC, is the most widely used type of chart today. Figure 3.7 shows a bar chart using the Nasdaq 100 Index Trust QQQQ. On the left side of each bar is a small horizontal line that represents the opening price. The highest and lowest points of each bar represent the high and low for the day. Finally, the close is indicated with a small horizontal line on the right side of each bar. This type of chart is sometimes called a range bar chart and can be created for any stock or index. Delayed quote as of December 19, 2005, 4 hours 59 minutes and 57 seconds p.m. ET. Last. 1259.92. Change. Down pointing arrow minus 7.40. Open. High. Low. 52-week high. 1267.210. 1270.510. 1259.360. 1275.800. Percent change. Volume. Exchange. 52-week low. No news currently available for S&P 500 index. Down pointing arrow minus 0.58%. NA. Index. 1136.220. Figure 3.6 snapshot quote of $SPX, source, www.optionetics.com. When studying the stock market as a whole, the first step is to look at the trend. Is it moving higher or lower? Bull market or bear market? As a general rule, a market qualifies as bullish if it experiences a 20% advance from a previous low. A 20% fall from a previous high indicates a bear market. Traders should focus on long positions during a bull market and short positions during a bear market. Remember, the trend is your friend. As you can see from figure 3.7, the Nasdaq QQQQ moved higher from May to December. The trend, therefore, was positive, or bullish, because the fund had risen more than 20% from its lows. It is technically in a bull market. When it comes to making investment decisions, technical analysts will generally be buyers in bull markets and sellers in bear markets. Trading the Market 39 Figure 3.7 Daily QQQQ Chart Source, www.profitsource.com. Market qualifiers: bull market, advance of 20% or greater from a previous low. Bear market, decline of 20% or more from a previous high. Correction, a move lower 5 to 20% during a bull market or a move higher 5 to 20% during a bear market. Pullback, a move of 5% or less to the downside during a bull market or a move 5% or less higher during a bear market. Retracements, a move counter to the prevailing trend. Technical analysts consider 23.6%, 38.2%, and 61.8% retracements to be significant. 40. Trend lines. The index trading course. Trend lines are one of the most basic ways to analyze specific markets, especially indexes. The lines are simply drawn on charts. When we started trading, we did this by hand with pencil, ruler, and paper. However, today, most charting software provides a variety of tools including the ability to accurately draw trend lines. The goal in using these lines is to determine whether bulls or bears are in control of the trend. The trend, in turn, is a prolonged period of time when the market or index is moving in one direction or another. If the market is moving gradually higher and setting a series of higher highs and higher lows, it is said to be in an uptrend. When an index is in an uptrend, the trend line is drawn on the chart along the bottom of the price. Figure 3.8 shows an example of a healthy trend and the trend line that is drawn along the series of higher lows. A downtrend, on the other hand, occurs when an index price falls over a period of time and sets a series of both lower lows and lower highs. When a stock or index is falling, the trend line will be drawn along the top of the price chart. The chart in Figure 3.9 shows an example of a nasty bear trend and the accompanying trend line. As you can see, trend lines are tools designed to capture the uptrends and downtrends relative to a stock or index. Traders want to stay on the same side of these trends. Technicians often use the adages, "the trend is your friend," and "don't fight the trend." Drawing trend lines is relatively straightforward. Today, lines can be Figure 3.8 Uptrend Chart using QQQQ, source, www.profitsource.com. 41. Trading the market. Figure 3.9 Downtrend Chart, source, www.profitsource.com. Created on index charts with most trading software programs and, in the absence of software, charts can be printed from a website and the lines can be drawn the old-fashioned way, with a pencil and a ruler. For instance, in Figure 3.9 the downward sloping trendline is drawn on shares of the QQQQ from January 2001 until March 2003. The fund then reversed course and started an uptrend, the one shown in Figure 3.8, which has continued to the time of this writing. Trend lines can also be used to identify trading opportunities. The first factor to consider is the slope of the line. Again, an upward sloping trend line is the sign of a healthy advance. A downward sloping trend line suggests that the market is weak. Once the directional bias of the trend has been identified, you can use a number of strategies to take advantage of it. Trend lines also serve as support and resistance. In the upward sloping trend line in Figure 3.8, each time the stock approached the line, it bounced off and made a move higher. This is considered trendline support. Once established, a trendline can, quite astonishingly, serve as a floor through which a stock price will not fall. On the other hand, in a downward trending market, the trendline can prove to be a source of resistance or a ceiling to higher prices. In Figure 3.9, the trendline clearly identifies areas of resistance. When a trendline is broken, it is sometimes known as trendline failure. For instance, the downward sloping trendline in Figure 3.9 was broken in early March and the trend shifted from down to up. In other words, the trendline no longer served as resistance and once the stock broke through it, shares made a significant move higher. Therefore, a trendline break can often signal a move in the opposite direction, which is called a reversal. The angle of a trendline is also significant. A very steep trendline suggests aggressive buying in the case of an uptrend or aggressive selling in a downtrend. Therefore, when a steep trendline is broken, it has greater implications than when a relatively flat trendline is violated. When studying trendlines, time is the final consideration. In general, the longer the duration of the trendline, the better the trend. Hence, when a 12-month trendline is broken, it has more significant implications than when a 3-week trendline is broken. The number of times a trendline is approached but not penetrated is significant as well. It is more meaningful when a downward sloping trendline that has served as resistance on a dozen occasions is broken, as opposed to the one that has only been tested 3 times. Using moving averages MA, can also help gauge the strength of trends. As the name implies, a moving average is simply the average, or mean, of a price over a fixed number of days. Generally, the average is computed using closing prices, or the price of the last trade of the day. For instance, if at the end of 6 trading days an exchange-traded fund closes for $40, $44, $50, $48, $50, and $52, the 4-day MA at the end of the 5th day is $48, 44 plus 50 plus 48 plus 50 divided by 4. As each new day is added, the last price is removed from the moving average. So, in this example, the 4-day MA at the end of the 6th day equals $50, $50 plus $48 plus $50 plus $52 divided by 4. Moving averages generally cover a period of 20, 50, or 200 days. Most charting software packages include MAs, so there is no reason to compute them by hand. Moving averages will behave differently based on the number of days used to compute the average. A 50-day MA, for example, will behave differently than a 200-day MA. The shorter the time frame, the more sensitive 42THE index trading course major trend lines, lines drawn on charts along long-term uptrends or downtrends that span many months or even years. Technicians consider these long-term trend lines extremely significant, as they often serve as support or resistance to higher prices. Minor trend lines, lines drawn on charts along short-term trends that last a few weeks or a couple of months. They are not considered extremely important when studying the markets using technical analysis. 43. Trading the market. The moving average will be to price changes in the stock. Consider the chart in Figure 3.10, which shows the price action of the diamonds along with both the 50-day MA and the 200-day MA. Notice that the 50-day moving average, which is above the 200-day, fluctuates more than the 200-day, because the latter captures a longer-term time frame. Some technicians say that the longer-term MA is slower, or smoother, and the shorter term is faster. Some traders will use very short-term moving averages, e.g., 9 days. The general rule is to use a moving average that corresponds with the time frame of your trading strategy. For instance, in looking at a stock for potential trades for the next 2 years, a 9-day moving average will not be ideal. It is too short-term, given that the strategy is long-term in nature. As with trend lines, traders need to consider the slope of the moving average. If a moving average is upward sloping and moving higher, it suggests that the trend is healthy, a favorably bullish sign for the stock. On the other hand, a downward sloping moving average suggests weakness and is bearish for the stock. In Figure 3.10, notice how the 50-day moving average will change direction much faster than the longer-term 200-day moving average. A simple moving average is created by adding up each closing price of the past number of days and dividing the total by that number. Hence, a 50-day simple moving average would consist of the sum of the last 50 closing prices of the index divided by 50. A second way to study moving averages is to look for buy and sell signals by considering when the stock price crosses over the MA. For instance, notice in Figure 3.10 when the price of the DIA fell below the 50-day MA in late February, it triggered a sell signal. The fewer the number. Figure 3.10 diamond chart with 50 and 200-day MAs. Source: www.profitsource.com. 44. The Index Trading Course. Of days used to compute the moving averages, the greater the number and the less the significance of buy and sell signals. So a break of a 200-day MA is considered much more significant than a break of a 9-day moving average. Moving averages can also serve as support and resistance zones. Figure 3.10 shows how the 50-day MA served as a support area for the diamond when it moved higher. Technical analysts watch the 200-day MA closely in this respect. You may have heard news reports that the Nasdaq Composite Index $COMPQ recently moved above its 200-day moving average. Many analysts view that as a powerful bullish technical signal because the penetration of the 200-day moving average symbolizes a break of a major resistance area for the index. The final way of using moving averages is to look at the crossovers between the two of them. When the short-term MA crosses over the longer-term MA, it triggers a buy signal. This occurred in Figure 3.10 during the month of May 2003 and the DIA surged. Conversely, when the 50-day MA drops below the 200-day MA, a sell signal is triggered. So far, our discussion of moving averages has used the simple moving average SMA. Exponential moving averages EMAs are used in the same way as SMAs, but are generally considered superior because the most recent data has a greater influence on the average when compared to the older data. When computing the average, the most recent trading day has a greater weighting. For example, in a 9-day moving average, the most recent trading day is given greater importance when compared to the price 9 days ago. As a result, the EMA will respond faster to changes in the trend and is therefore a more reliable indicator. The exponential moving average is used for the remainder of this book. Simple moving average, a series of successive averages that is defined by a set of variables. As each new variable is added, the oldest or last variable is removed. Moving averages are often computed for stock prices to view trends over time. 50 and 200-day moving averages are among the most common time frames. Exponential moving average, a type of moving average that gives greater weight to the latest data. For example, to compute the 10-day exponential moving average, the analyst might take the closing price of the 10th day and multiply this number by 10, the 9th day by 9, the 8th day by 8, and so on. As a result, it responds faster to new prices and less to old data. For that reason, some trades prefer the exponential moving average over a simple moving average because it offers better information regarding the most recent trends or prices. Volume is an important consideration when looking at the action in the index market.